Hello everybody, Professor Barth here, Associate Professor of History at Arizona State University. Going audio only today, and I apologize for the poor quality audio, but if you can hang with me. The Bureau of Labor Statistics released their November CPI numbers earlier this week. A lot of positive headlines about inflation cooling in November. The year-over-year CPI rose 7.1%. And then the following day, the FOMC announced that they are raising rates, the federal funds rate, half a percentage point or 50 basis points, which the market seemed to have been very taken aback. The Dow earlier, this is today, tumbled 900 points. So people are fearing that Powell and the Fed are overreacting and that they are continuing to raise rates even though inflation supposedly is slowing. And we'll take a look at these inflation numbers here in a moment and also the Fed's response. Let's begin with the numbers. Here's a graph of year-over-year CPI since 2021. As you can see, at 7.1%. Historically, this is very high. Remember, the Fed's target rate is 2%. And I disagree with that. I don't think 2% inflation, that's a very Keynesian notion, really, that you ought to have a target rate at all. I'm not even opposed to deflation. I think I've come from a Hayekian view that you have to allow the price system to work unencumbered. But 7.1% year-over-year CPI is quite high. I mean, by Fed standards. But the positive news seems to be coming from a look at the month-over-month numbers, and you see the CPI month-over-month, which is a way to zoom in and see what's happening in the more immediate period. Consumer prices on the whole rose 0.1% for the month of November. And so really since July, middle of summer, the month-over-month CPI hasn't exceeded 0.4%, which is seen as a success given the first half of the year. I mean, you look at that first half of 2021, it's bad. 0.6%, 0.8%, 1.2%. April was a little lower. But then 1% May, 1.3% June, that's really when it peaked. And then July it flatlined, and then since then it's been more moderate. If this can continue, if this trend continues, then year-over-year inflation will be lower than 7.1% this time next year. The question is, can that continue? Will that persist? These lowish month-over-month numbers in the CPI, that remains to be seen. Core is, you look at the core numbers here, this is core CPI year-over-year at 6%. Remember, core excludes food and energy, more volatile sectors, so CPI minus food and energy. Core CPI at 6% is just as high, if not slightly higher, than year-over-year core in the early part of this summer. I'm talking July, June, May. Core CPI is higher, or just as high as those months. So we really haven't seen in core a major move downward. And if you zoom into month-over-month, again, if this trend continues, that's a positive sign that inflation may be getting under control. 0.2% was the core month-over-month for the month of November. 0.2% is still high, frankly, for a core. Core 0.2%. Now I know the forecast was 0.3%, which is what it was for the month of October. But if that number, core CPI month-over-month, can stay down at a lower level for several months in a row, okay, we're talking about year-over-year inflation getting somewhat under control. And by somewhat under control, I mean under 5% year-over-year, which is still way too high. But if you want under 5% year over year CPI, if you want 4% or 2% which is the target, having 0.1, no higher than 0.2 increase in core CPI month over month is key to that. But I don't quite see it yet. I don't see it yet, and which is why Powell, for as much criticism as I've levied toward Powell, I think Powell he has the right instinct here that rates have to continue going up. Okay, and the big headline, of course, yesterday was the Fed raised rates 50 basis points. That's following 4 successive increases of 75 basis points. So an increase of 50 basis points is a tad smaller than previous rate hikes, but 50 basis points is still high. It's higher than a quarter, which is what the Fed was previously accustomed to. And and you zoom out a little bit at the federal funds rate since 2015. That's a steep increase. Okay, it's a steep hike in rates in a fairly relatively short amount of time. Now, here's where we are historically. It's the late 1960s, and you look at this chart and you're like, whoa, you still have a long way to go. But right now, with the federal fund, the upper limit of the federal funds rate, the target rate, capping out at 4.5%, interest rates are higher than they've been since 2008. Will they need to go higher? Well, the FOMC is projecting that they may have to go as high as 5.25% next year. I think they may need to go higher than that. But at the press conference, this is what really put a damper on the markets. Powell said yesterday, restoring price stability will likely require maintaining a restrictive policy stance for some time. Well, yeah, no kidding. Got to do it. The Fed, we've had extreme, radical, easy money, soft money since the pandemic, and really since the 2008 financial crisis, if you want to zoom out. But yeah, you're going to need, if you want to bring inflation realistically under control, a restrictive policy stance is necessary. It is our judgment today, Powell continued, that we are not at a sufficiently restrictive policy stance yet. We'll stay the course until the job is done. And so the markets, of course, after that press conference, the headlines, Powell paints hawkish picture, and then the markets have just gone. Look, markets are not rational necessarily. Sometimes they can be, but sometimes it can be irrational, and people like that easy credit. They like that easy money, and I think there was just a lot of hope after a slightly better than expected CPI reading for the month of November. I think it was projected at 7.3%. It was 7.1%. That's not that big of a difference, but there was a lot of expectation. Okay, maybe the Fed will just raise rates by a quarter, or if they do 50 basis points, they'll signal that a restrictive policy will end very soon. And Powell did not signal that. He's saying it's going to take some time. He's right about that, but the markets, they just don't like it. They like that easy money. They like all that easy. The low rates allow for all that speculative activity in the markets, and so the Dow didn't respond so well to that. But it makes sense. The Fed, the restrictive policy, makes sense. The Fed has to. The Fed has to do something to calm the consequences of the actions that they took since 2020. Here's the Fed's balance sheet for the calendar year 2022. It's gone down a bit. You can see from its peak at almost $9 trillion, which is unbelievable. $9 trillion of assets at the Federal Reserve from its peak in the late spring. But you zoom out again, look at all that QE in 2020. The Fed's balance sheet really hasn't shrunk that much. It's done a little bit, but not that much. And then you look at M2, the money supply, it's gone down just barely. I think from 21.7 trillion to 21.4 trillion or something. It's gone down like 2% from an increase of 40% since the pandemic. So what should we expect for 2023? I mean, this could kick in a recession, but what's Powell supposed to do? And in studying history, I think one thing that Powell has to watch out for, in the 1970s, in the early part of the 70s, there was pretty severe inflation. I think it hit double digits in the early 70s. And then Arthur Burns, who was the Fed chairman in the 1970s, hiked rates quite quickly. Inflation got under control, and then once inflation got under control by the mid-70s, Arthur Burns cut rates. He stopped the restrictive policy and gave the green light to easy money again. And what happened to inflation? Inflation just shot right back up, so that by the late 70s, inflation was 15%. And then you had Volcker come in, and Volcker took it here. Okay, you see around 1980 with the interest rates. But so yeah, I think Powell has the right mindset here. That's not the time to end the restrictive policy, because you have to. Now you take a look at the numbers. I'm not going to go through all this. Food year-over-year CPI is still, it's 12%. Although the positive picture number here, food month over month. If you look at total food, including food at home, the grocery store, as well as food away from home, food prices month over month only went up 0.2% in November. That's positive news. You look at the previous months there. So this is the best. These were the best food prices that we've seen for a year and a half, as far as inflation is concerned. The lowest level of food inflation in November. That's positive. See if that can continue. Tell you what, lowering rates, which is what the markets want, easy money, which is what the markets want. That's not going to cause food prices to stay at a low level. They would shoot right back up. So that's some pretty good news. Energy is just wild, but there's energy. Energy went down month over month. We're still at up plus 13% for the year. Gasoline was down 3.6% in the month of November. Of course, a lot of this energy movement is due to Biden opening up the strategic oil reserve, which is in my opinion, a pretty catastrophic and very short-sighted move by the President of the United States, but that's had some effect on energy prices. And then you go down the line. And so there has been a bit of a, it's true, there has been a bit of a cooling of inflation if you zoom in month over month, but I think the Fed does need to continue to restrict, continue to tighten, and markets aren't going to like that. So we'll see what happens in 2023. Will there be a recession? What's going to happen with the inflation numbers? I hope you have a very Merry Christmas and Happy Holidays, and talk to you all later. Bye.